Gentlemen. So hopefully, I'm not sure if you can actually see me or hear me or see anything. If anybody's watching right now, chance that nobody's watching because it was a last second thing. We wanted to create webinars for every successful thing that we've tested. And in the last month and a half, team of Sihan, Agonki, Cord, and Andy did a great job, tremendous job of testing many different things. Unfortunately, for the most part, the majority of our ideas, the majority of stuff that was tested did not really turn out to be successful in terms of actual practical implementation. Not because we didn't try it, we actually tried implementing some of these things, right? But for the most part, we just saw the results and we saw that, you know, if something is too good to be true, chance that's not correct. But the last task that took the team almost 3 weeks to complete, if not more, almost a month overall, actually turned out to be something pretty sophisticated. So if you're not gonna be able to watch it live, just watch a recorded version of it, as you can find really cool things for yourself, hopefully, and finally see that testing, even back testing, does present very solid results for trading, for forecasting trends, for forecasting volatility, for really adding value to your trading game, investing game, research game, whatever you decide to persevere in your life, in your future life. And yes, of course, it's way better to have you know, some information that nobody else has in terms of live information. However, if such information does not exist, then at least go for the historical information and try to exist and try to explain what it is, right? Try to find out some metrics that could be used. So, long story short, the team prepared this amazing spreadsheet. We edited it, of course, a little bit, but basically what it does is it has all the data for various metrics: bullish gaps, bearish gaps, low 52-week low, 52-week high, scenarios based on RSI and ADX. RSI above 70, RSI below 30. Scenario 5 in volume, different moving averages, different moves of stocks, as well as different level of activity based on volume, as well as cumulative dollar volume up and down, as well as checking indexes, as well as ADL indexes. So all that stuff was not only prepared for S&P 500, no. It was prepared for every single constituent of S&P 500 and averaged out down the line amongst the S&P 500 constituents. So what we have here, all the data that this guy's prepared, is right there based on the percentages. So for example, here, the 4.666, if you convert that into percent, we can say that 4.7% of all constituents of S&P 500 had a bullish gap between 1 and 2% on January 3rd, 2008. We can do the same thing for 52-week low, for example. And we're going to say that say here, 1.7% of all the S&P 500 names had a 52-week low on December 29th, 2008. Hopefully you guys can see it. So this is really cool stuff. But now what, right? So you guys prepared all that statistics for what? You spent 3 weeks in your computers, spent hours computing it. I know that for sure because last time we actually did this on corporate computers here, and yeah, it took a lot of time. It took a lot of time to run this. So let's look into certain indicators that we found to be influential in forecasting certain bottoms of the market as well as volatility. So we have them written here, and obviously that was just preliminary analysis, which only spent an hour of our time, not more. But what we found was pretty striking. So for example, I just want to make sure that you guys understand what you you've conducted. You've conducted something really, really cool. So 52-week low, right? So let's say that's the line for 52-week low. And we draw the line compared to the S&P 500 over the same period of time. And this is the chart that we get. Obviously, we need to make sure that the chart is edited properly. So here, for the 52-week low, we'll select the second series. Boom. So the blue line will represent what's the percentage for all the S&P 500 constituents actually had a 52-week low on that given day. So let's convert that into, you know, proper format. Boom. All right. So, and this is just S&P 500 on this side. So as we can see, and let's also do the formatting here. Even less. So even let's do like a 500. All right. That's great. Minimum. Oh, 300. Okay. So what we can see right here is this. It's a quick thing in Excel. Doesn't take much. This is our storytelling line. We'll make it some color. We thought orange is the best because it's more visible. So what happens is this. Every single time you see a spike in the 52-week low ratio, for the most part, it does indicate a low. It does indicate some kind of correction. And most of all, it indicates the end of that correction. So the very next day, the S&P 500 turns out to be spiking. Check this out. Check this out. Check this line out. Check that line out. Check this line out. So check this line out. That was Brexit. So obviously, we have to test it more, right? We have to clearly look at more than just one indicator. However, that indicator by itself, of 52-week low percentage compared from the S&P 500 constituents, is pretty telling about what's really going on. It's pretty telling that chances are it's a dip, chances are it was some emotional sell-off, and chances are right after that, the S&P 500 will go up. So a particular trading strategy for that could be every single time we see a spike of 52-week low, all of a sudden of say 10+%, we go for high beta names in S&P 500 because we expect S&P 500 to go up. Therefore, high beta names will actually add up to the positive volatility on the upside. Obviously, you guys have to watch your stop losses because chances are you will be exited out. But nevertheless, given this scenario, 52-week low is a pretty telling indicator of a market dip, right? So that was one of them, right? We're not going to go through all of them. We're just going to go through the ones that we found pretty telling. Now, oh, that's a big one. All right, so let me actually okay. So I did something. Obviously, yeah, because I missed the 2008, so I want us to look at that too really quickly. 2008 was not. All right, so here now. Let's edit this back to whatever it was. That was just ARA. All right, here we go. All right, that's a better graph. So coming out of 2008, right there was another dip, 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 dip. All right, so every single one of these guys do offer us some information about what's really going on. Next indicator, which is pretty cool. Surprisingly, when you look at the 52-week high, it's not necessarily representing the high. It will not necessarily represent anything because as the stock market is getting hotter, more investors are getting into it. So it's a panicking buy, actually, panicking purchase, especially if it's associated with high volume. Let's look at RSI below 30. So RSI below 30 will indicate that the market is oversold. Therefore, it's logical for the market to start going up. So let's look at that. Really just change this to T. That's going to be RSI below 30. All right, what do we see? Some unclear and really short correction up, but still correction up, bottom, bottom, bottom. Let's do a small correction up, yet another bottom to retest it, another bottom with small correction, bottom with a good indicating a new bearish trend, bottom, bottom, bottom. RSI less than 30. Again, so if you look at all the constituents of S&P 500 and look at which ones we're trading below RSI of 30, gather together into one cumulative stats, this is what you're gonna get. Really cool stuff as well, right? So pretty telling. So now you can start thinking about, and also there are also small dips. Like for example, this is a small dip, this is a small dip, this is a small dip. So again, the strategy can be buy stocks, either cyclical stocks or high beta stocks, every single time that there's a spike in RSI below 30. Right, so this RSI below 30. The computer is probably going slow, but this RSI less than 30. Now, let's look at unusual activity in volume, right? So we're looking at volume at twice its 3-month volume, right? Volume, yeah. So volume that twice exceeds its 1-month volume, so that's going to be AM. Let's do that. AM. So at first, doesn't really tell us much. Like what's really going on with the spikes. Yeah, there's a spike indicating this. Brexit, there's a spike indicating this bottom. There's this spike. But what's it's really indicating is that for the most part, chances are something is going to happen. It's either going to go up or going to go down. So what are the strategies for that? So basically, high volume in this situation might be an indicator for more volatile moves down the road. More volatile names down the road without any specific direction, meaning that you would like to buy volatility. How can you buy volatility? You can buy volatility by playing options. So you can buy straddle, you can buy strangle. Yes, they're expensive, but if nobody knows that the volatility is going to be spiking and you do, then you could buy it. Of course, given the fact that there is a huge spike of volume before that, maybe the volatility is going to be a little bit more expensive than usual. However, you know that the delta move right after that particular spike might compensate for any loss in Vega, even if volatility is expensive on that given day. So you could either just strictly buy vol, or you can buy some kind of option structure where you don't pay as much on the on the premium, yet you still get exposure to the volatility either way, whether it's going up or going down. You can play a strictly delta move here. But the delta move has to be, well, actually, no, you can't, because the delta move is really directional. So yeah, the only thing here is really vol that you can do. So you can look at whatever the option structures you have or you have in mind to try to play that. So that's yet another indicator. Same thing will happen when we're talking about twice the 3-month volume. Twice the 3-month volume is AK. So it's very similar in nature, right? So these are really cool findings that we finally got. Yes, it took us. It took you guys 3 weeks, and it took all of us a lot of time, a lot of nerves to actually finish this project. But this one is actually pretty telling as well. Huge spike, something is really going to go. A huge spike, huge spike, huge spike. We don't know exactly if it's bottom or up, but we know that something is up. We know that there's going to be some move up or down. Now, what else? There are various scenarios. For example, scenario 2, which is based on I will tell you specifically what it's based on. Just give me a second. So scenario 2 is based on the fact that RSI is above 70 and ADX is less than 20. So if you look at that, and our scenario is K. Okay, boom. So what it tells us is that sooner or later, the market is about to recover. Sooner or later, you need to buy more and add to a rather longer term position, with some small correction down the line. However, if you are how to say, if you prefer fundamental analysis more than technical analysis, this scenario too might be a great indicator for you to add to your position. Obviously, you might lose some on the small correction. However, that might be a very good point to enter into a position for stocks that you believe are undervalued, that you believe are selling at cheaper price than they should, because the correction in the market is about to be coming, and it's a great time to exercise your longs. Same thing with scenario 4. Scenario 4 is M, and I'll tell you what it is. All right, so here what we're doing is this. If you look at, let me draw out another line. Again, we didn't spend much time. We didn't really statistically analyze it. We just analyzed it based on what we saw. We could be biased, obviously. That's why further statistical analysis is absolutely necessary. However, if you look at points less than 5%, so every single time this line. So what is scenario 4? Scenario 4 occurs when ADX is above 25 and positive DI is less than negative DI. So basically, scenario 4 indicates positive trend as described by the ADX. So when that trend is below 5%, if less than 5% or less percent of the constituents of the S&P 500 are showing positive trend, then chances are the positive trend is about to begin. All right, and as you can see in areas right there, areas right here, let me just make it okay. As you can see in areas right here, here, okay, here, here, here. I'm moving this chart, of course. As you can see here, they do show certain potential places of upside. And again, that's where you fundamentally would add up to a much larger position that you currently own. Again, it's a more fundamental play because from what it seems like, it does look into rather longer term trends. So it does establish a rather longer term trend for the next couple of months. And if you have any fundamental view on certain sector, then chances are, because you can also do the same thing for the sector, right? You can split that into sector. Don't do S&P 500 by itself. Do like say XLBs or something like that. Man, that's clear. That's probably clear. Now, I don't know how many people are watching me. In fact, probably nobody. Nobody's watching me right now. That's perfect because yes, we did it last second. That's the only time I personally had. I do apologize for this. It was rather quickly, and we didn't really tell anybody anything in advance. Hopefully, this is useful. Hopefully, you can finally see that what you've been testing is actually pretty cool stuff. It's extremely useful. Yes, it's based on historical data, but historical data has a lot of value-added information that many people do not consider because they just don't know about it. I just want to wish you, as we have a couple of weeks left before the end of the internship, we will be giving more tasks very soon. However, I would like to make sure that you guys really think more outside of the box about any task that we give. Usually it's Sihan who is looking into, who's managing the process. Guanqi did a great job helping us finish this last project. But again, like the words of wisdom, rather, right? The words of direction here is try to, whatever the task you have from us, or whatever the idea you have from, reading literature or stuff like that, try to really analyze it, try to really think how it could be used practically, and share those ideas with us. Share those ideas on the Facebook page with your team members, and let's try to create something cool. Because in the trading world, sure, every single secret is a secret. Yeah, you should not reveal it. But at the same time, how many times you say an idea which you think is brilliant and nobody really cares about it? Same thing applies to trading, unfortunately. What are the great ideas you have nobody's really going to steal it because nobody knows how to implement it anyways. But what it does give us, does give us a way more well-rounded outlook on the stock market. And it's just interesting to share ideas, just interesting to open up your horizons and think a little bit differently from what you've been thinking before. Not because basically because of synergistic effect, right? Because of synergistic effect, because we all have different backgrounds, we all think differently, and certain ideas could track some new thoughts in your heads regarding the stock market or regarding any other markets that you might be interested in, whether it's commodities or fixed income or forex. So this is it. Thank you so much. I will put this on recording. If you do have any questions, please feel free to ask them in our Facebook page. Again, sorry for this last second presentation, but again, we were just mind blown. We were just mind blown by that when we saw it on weekends. We really just analyzed it over the weekend ourselves, got together, and we found really good results. So thank you so much. Hopefully you enjoy this internship. Bye bye.